Welcome to Markets in Minutes, the macro-microeconomic and financial commentary companion podcast. I am your host from the macro-micro research team, and this is our weekly deep dive into the forces shaping global markets and economies. This week, we're examining three critical developments that are reshaping the economic landscape. First, we'll explore how the Trump administration's implementation of reciprocal tariffs represents not just trade policy, but a comprehensive strategy to cement US financial and technological dominance. Second, we'll analyze the Federal Reserve's first descent of 2025 and how it collides with the Treasury's massive $1 trillion borrowing surge in Q3. And finally, we'll break down Big Tech's Q2 earnings, which reveal a clear divide between companies that are successfully monetizing AI and those still building their capabilities. Let's dive in. The Trump administration's tariff framework, which went live on August 7th, represents far more than traditional trade protection. Our analysis indicates this is a carefully orchestrated strategy that combines economic pressure with financial architecture reinforcement. The tariff structure itself follows what the administration calls a reciprocal framework, with rates ranging from 10% to 41% based on trade balance dynamics. Countries running trade surpluses with the US face a baseline 10% tariff, while those with deficits start at 15%. But here is what makes this particularly interesting from our perspective. Strategic exemptions remain in place for Section 232 products, including semiconductors, automobiles, and pharmaceuticals. This isn't an oversight. It is deliberate economic statecraft. The data shows us that Canada faced immediate escalation from 25% to 35% under fentanyl-related measures, while Mexico received a 90-day negotiation extension. This demonstrates the administration's willingness to use both punitive and accommodative approaches simultaneously, a nuanced strategy that goes beyond simple protectionism. What our research reveals is particularly noteworthy. The framework includes transition clauses, allowing goods shipped before August 7th to clear customs under previous rates until October 5th, 2025. This operational buffer suggests the administration understands the complexity of global supply chains and is managing implementation to minimize immediate disruption. But the real story lies beneath these headline tariff numbers. The administration is simultaneously implementing what we call complementary financial architecture measures. The Genius Act, passed July 18th, links stablecoins directly to US Treasuries, potentially unlocking $1 to $2 trillion in new Treasury demand. When combined with proposed supplementary leverage ratio, changes that could create another $1 trillion in Treasury holding capacity, we're looking at a fundamental restructuring of global dollar demand. This isn't just about trade, it is about cementing dollar dominance in an era of emerging digital currencies and geopolitical competition. The technological component of this strategy cannot be overlooked. America's AI Action Plan, announced July 23rd with 90 federal initiatives and 4 proposed nuclear revival programs, reflects what the administration frames as computing power equals energy equals national power. Our analysis suggests that tariff policy serves as one component within a comprehensive approach to maintaining US financial and technological hegemony, particularly amid challenges from China's emerging technologies like DeepSeek. Now, let's turn to the Federal Reserve, where we're witnessing the most significant shift in monetary policy consensus this year. The July FOMC delivered a historic 9-2 vote to maintain rates at 4.25% to 4.50%, marking the first descent of 2025. Board members Bowman and Waller broke ranks to advocate for an immediate 25 basis point cut. This descent represents a fundamental shift in Fed consensus, with the statement removing language about diminished uncertainty while adding that first half economic growth has moderated rather than continued at a solid pace. Powell's press conference marked what we observe as a notable pivot in Fed communication. The chair repeatedly emphasized that the Fed is highly attentive to the risks of a weakening labor market, describing current employment conditions as merely solid rather than robust. This linguistic shift reflects underlying labor market dynamics that our data analysis reveals as particularly concerning. We're seeing simultaneous slowdowns in both job creation and labor supply, keeping unemployment stable. But at what appears to be a fragile equilibrium, the economic backdrop supporting this dovish turn is concrete and measurable. Powell's assessment that first half 2025 economic growth has moderated aligns with our data showing GDP expansion slowing from 2.5% in 2024 to just 1.2% in the first half of 2025. The composition of this slowdown is what concerns us most. Final sales to private domestic purchasers have reached their lowest level since 2022, while interest rate sensitive sectors like housing investment and commercial real estate show clear signs of weakening. The Q2 GDP numbers provide additional context. While headline GDP rebounded to 3.0% quarter-over-quarter annualized, this was driven mainly by a sharp drop in imports of negative 30.3%, reversing prior front-loading tied to tariff expectations. When we exclude trade and inventories, core domestic demand, what we call final sales to private domestic purchasers, slowed to just 1.2%, a post-2022 low. Services spending, the largest component of consumer expenditure, grew just 1.9% year-over-year, signaling genuine softening in consumption patterns. Here is where the story becomes particularly complex. The Treasury has announced a dramatic increase in Q3 borrowing from $554 billion to $1.007 trillion, representing one of the largest quarterly funding surges outside of crisis periods. This surge is driven by the urgent need to rebuild the Treasury General Account from its current depleted level of approximately $360 billion back to the target of $850 billion. The scale of this replenishment requirement means Treasury will need to issue nearly $500 billion in additional debt beyond normal operational needs. Current liquidity conditions appear robust on the surface, with depository institution reserves at approximately $3.36 trillion and the overnight reverse repo facility declining to around $150 billion. However, this apparent abundance masks a coming squeeze. Treasury's massive TGA rebuild will mechanically drain reserves from the banking system, with every dollar of Treasury issuance that gets deposited into the TGA reducing bank reserves by an equivalent amount. The Treasury Borrowing Advisory Committee's decision to meet this funding need primarily through increased T-bill issuance, rather than expanding long-term bond auctions, will concentrate this liquidity absorption in short-term funding markets. The cross-currents create what we're calling an August-September crunch period. Markets are interpreting the Fed's dovish turn as a signal that rate cuts could be coming, with rate futures now pricing in 75 basis points of cuts in the second half of this year and another 50 basis points expected in 2026. The 2026 voting rotation will tilt more dovish, with hawkish members like Schmid and Musalem losing their votes, while Fed Governor Kugler recently announced her resignation. Leading candidates to succeed Powell, including Kevin Warsh, Kevin Hassett, and Christopher Waller, all support rate cuts. Turning to big tech's Q2 earnings, we're witnessing a fundamental shift in how investors evaluate AI investments. The earnings divergence among big tech giants demonstrates that proven AI revenue streams have become the primary factor determining market valuations rather than traditional growth metrics or ambitious spending promises. Microsoft delivered exceptional Q2 performance with adjusted EPS of 3.65 versus 3.38 expected, and revenue of $76.4 billion, beating forecasts significantly. The Intelligent Cloud segment reached $29.8 billion, surpassing analyst expectations, with management noting that AI-driven demand continues to outstrip capacity across Azure infrastructure. This capacity constraint isn't a problem, it is validation of sustainable, competitive advantage. Enterprise adoption of Microsoft's AI services creates what we observe as a sustainable competitive moat, with Azure's leadership in AI-powered enterprise solutions positioning the company to maintain premium pricing and market share gains. Meta significantly exceeded expectations with EPS of 7.14 versus 5.89 expected and revenue of $47.5 billion, representing 21.6% year-over-year growth. Advertising revenue reached $46.5 billion, with the company's AI-driven ad placement technology delivering what management described as higher efficiency and revenue as advanced algorithms improved targeting precision. Daily active users reached a record high of 3.48 billion, demonstrating AI-powered personalization driving unprecedented engagement. Meta's strategic positioning particularly interests us. The company's aggressive AI talent acquisition, including former OpenAI researcher Shenjia Zhao to lead its new superintelligence lab, and Apple's head of AI foundation models, Ruming Pang, signals a deliberate push to secure top-tier AI talent. This is paired with massive infrastructure investments, including the planned 5-gigawatt Hyperion facility, part of a broader multi-gigawatt data center expansion. Meta recently revised its 2025 capex guidance to $66 to $72 billion to accelerate AI development. Unlike more speculative AI ventures, Meta's ability to immediately monetize AI advancements through advertising efficiency creates a self-reinforcing cycle. Apple reported Q2 revenue of $94.04 billion, representing a 9.6% year-over-year increase and beating consensus estimates by 5.75%. iPhone revenue surged 13.5% to $44.58 billion, while services revenue grew 13.3% to $27.42 billion. Geographic performance was particularly robust, with rest of Asia-Pacific revenue jumping 20.1% and Europe growing 9.7%. However, Apple faces mounting pressure over its slower AI rollout compared to competitors, with analysts warning that delayed Siri improvements and limited AI integration could damage Apple's innovation reputation. Amazon reported Q2 revenue of $167.7 billion, climbing 13% year-over-year and surpassing expectations. AWS generated $30.9 billion in revenue, with 17.5% year-over-year growth. Though, this represented a moderation from previous quarters despite meeting analyst forecasts. Amazon's planned $100 billion in AI infrastructure spending through 2025 failed to prevent growth from significantly trailing behind Microsoft Azure's 39% and Google Cloud's 32% growth rates. Q3 operating income guidance fell short of analyst expectations, contributing to a 7% after-hours stock decline, despite strong overall earnings performance. The consensus commitment to massive AI infrastructure spending, with Google raising 2025 capex to $85 billion, Meta allocating $66 to $72 billion, and Amazon planning $100 billion in investments, positions the Nasdaq 100 for continued double-digit EPS growth through 2026. The Magnificent Seven's 33% S&P 500 share reflects AI leadership driving market dominance, with sustained AI investment cycles creating unprecedented capital allocation requirements alongside double-digit EPS growth sustainability. Looking ahead to this week's key economic events, we'll be watching several critical data points. US services PMI on August 5th is forecast to rebound slightly to 51.5 from 50.8, reflecting stabilizing consumer confidence amid tariff negotiation progress. China's exports and inflation data on August 6th and 8th will provide insight into global trade dynamics, with July exports expected to hold steady at 5.6% growth. Taiwan's exports on August 8th are projected to grow 15% to 20%, driven by Nvidia's GB200 chip demand, despite slowing stockpiling momentum post-tariff agreements. To summarize this week's key insights, the Trump administration's tariff implementation represents a comprehensive strategy combining trade pressure with financial architecture reinforcement and technological dominance initiatives. The Federal Reserve's first ascent of 2025 signals a fundamental shift toward dovish policy, just as Treasury's trillion-dollar borrowing surge creates Q3 liquidity challenges. And in big tech, Q2 earnings reveal that AI monetization has become the new competitive moat, with companies demonstrating scalable AI revenue streams, significantly outperforming those still building capabilities. These developments collectively suggest we're entering a period of significant structural change, where traditional economic relationships are being reshaped by technological advancement, geopolitical competition, and evolving monetary policy frameworks. The convergence of these forces in Q3 creates both opportunities and risks that will require careful navigation by investors and policymakers alike. That concludes this week's episode of Markets in Minutes. Want more insights like these? Join our Max subscription for full access to expert reports and in-depth market analysis that goes beyond the headlines. Thank you for listening, and we'll be back next week with continued analysis of the forces shaping global markets and economies.